Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at MarketSite, we have Rohan Reddy, Director of Research at Global X, to discuss investor influence on ESG and covered call strategies that could potentially derive income for investors. Rohan, it's great to see you as always. Welcome back to Trade Talks.
Great to be here, Jill.
Let's talk about those investment mandates and the influence investors have on ESG, an increasingly growing category.
Absolutely, and we've seen ESG has become a huge part of the overall investing landscape, both for institutional investors and also retail investors. So what we wanted to do with some of these new products is essentially bring both an income mandate and also an underlying ESG mandate into one wrapper.
So how would that work then? So you get the underlying ESG, right? And then you use the covered calls to help derive that income?
Yes, so we've done covered call strategies for quite a long time at Global X, and one of the key asks we got from investors was, is there a way to do this in an ESG-friendly manner? And so we essentially used Nasdaq 100 and S&P 500 ESG indexes in order to use that for underlying equity exposure while also then writing covered calls on top of that. So it's not all that much different from a standard index, just with an ESG-friendly overlay.
What about diversification? Does it help to reduce volatility in this kind of market?
So the key with that is certainly on the sector differences. So what we've seen is, especially on the S&P 500, which is a slightly more diverse and broader index, there are some key sector differences in terms of there might be an overweight towards information technology companies and maybe an underweight towards other less ESG friendly sectors like industrials, consumer discretionary, utilities. So you might get a slightly more heavily growth oriented overlay, but what we found is that in overall long-term markets, ESG actually in some cases tends to outperform. So it's actually not as growth focused and volatility heavy as you might think in the long term.
So you'd mentioned some sectors that are more ESG friendly than others. What's the methodology like in terms of stock selection for the underlying portfolio?
It's quite straightforward, just given that these are relatively large and very widely followed indexes. So what we're doing here is essentially excluding a lot of companies rather than doing an inclusionary mandate. So we're excluding certain companies and sectors that might have less, say, ESG-friendly types of business activities. So an example might be maybe some companies in industrials and defense sectors, others that might be using, for example, tobacco-related products. So some of the standard categories that are less ESG-friendly, we're excluding some of those companies, but it's not like these indexes are all that much different than the standard indexes.
How would an investor incorporate this in their portfolio?
Well, we think there's two major ways that they can do so. First, for ESG-friendly investors, it solves a couple of things. First, you have the underlying equities that might make more sense for your portfolio from a long-term perspective. And then the second category is also on the income mandate. So just given that a lot of ESG equities might not be kicking off high yields, this could give you certain income-oriented objectives that may be solved compared to others. So it could be used both for ESG investors and also for others who may view either tactically or in the long term that income is preferred.
Right, and I would imagine for advisors, because it's in this ETF wrapper, including the covered call options, that it is advisor friendly, as they're looking to build out their portfolios.
Absolutely, especially because a lot of the self-directed investors who are now using advisors, they might prefer ESG equities. So it allows advisors to solve a couple of issues in the sense that they're already gravitating towards these strategies because their clients want them, and they're getting yield right now in an environment that if we start to see interest rates peak out, which it seems like the Fed has guided that they may do so, this could actually be a still relatively high yield strategy.
All right, Rohan, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.